So today we're hosting Chris Miles to learn about the wealth wheel and how to maximize passive income with the max ROI infinite banking strategy. Um, Chris is the founder of Money Ripples, and I'm really excited to host him today because I have seen several investors using the products that he has available for investing in some of the deals like Tempo Income Fund and others that are doing big things with their it's a life insurance policy. So I'm going to learn more about it myself while we're on this call. And feel free to put any questions that you have in the chat box. We are going to answer them as we go, if we can, but also at the end, there will be a chance to ask questions live. So thanks for joining us, Chris. I'll let you take over the screen now.
Yeah, I appreciate you having me here. So, like I said, always a pleasure to be on with you guys. I know you guys have serviced my clients really well as in over the years too. So, really excited to have you guys on. And not to mention, the whole third-party auditing thing. That alone is a pretty awesome deal right there, I'll tell you. So, all
Yeah,
right. So, oh,
it's
sorry,
a
go ahead.
it's a big task, but it's definitely creating a lot of security and people really like that.
Yeah, no, we need it now more than ever. In fact, I'll give a shout out for Alistair too. His podcast episode literally just launched this morning on my podcast as well. So, yeah, great guy. You guys got to make sure you attend that one for sure. So, all right, well,
Thanks, Chris. And let me introduce Chris. He is the anti-Wall Street financial advisor. He's a great dear friend. He's one of the most brilliant folks that I know. Besides the infinite banking and working with financial planning, he's also a brilliant ballroom dancer. For those of you who don't know, one of the conferences, he had us all get up and start moving around and shaking our hips. So this is a hidden talent. Not many people know about it, but now you know about Chris's brilliance, not only in financial planning and infinite banking, but also if you want to see him do some hip moves. He's one of the most
He's a great
talented,
teacher.
brilliant folks. Yes, he's a great teacher too.
That's right. Zoom, you can't tell right now. My hips are shaking right now. So that's the problem. You guys got to see me live, I guess, but even then I probably have only accept dollar bills or something like that to do it for you. So, all right, before I get to go too far down that little bad rabbit hole, let's kind of jump into stuff about how to make more wealth right now. Right. And so, yeah, I appreciate that, Mike. I appreciate Deanna as well. Cause yeah, I am definitely the anti-financial advisor, meaning really kind of going back with my story which I'll get into in a bit, but I'm definitely not about set it and forget it, save it forever, basically save and slave, that kind of perspective, when it comes to that kind of stuff. That's not my thing. I'm all about like what you hear here all the time, which is, how do we create wealth now, right? How do we create cash flow now? How do we actually create freedom right now and that sort of thing? But today my focus is really going to really talk about how we can show you how you can store your savings where it's high returns to the bank, but safer than stocks, tax-free, protected from sue-happy predators and creditors. And it can become a passive income booster that pays you twice, shaving off years towards your financial goals, just like hundreds of my clients and I've already done. That's something you want to see? Awesome. And like Deanna already said, feel free to go ahead and put, any questions that come up along the way. I probably won't be able to see the chat questions, but throw them in there because we will address it as we get to the end. All right. Well, speaking of before I did ballroom dancing, this is me. I was 17 years old. This is me and my dad. And he's kind of my inspiration for what helped me become an anti-financial advisor, because he was actually the one that really inspired me to become a financial advisor when I was the mainstream traditional financial advisor over 20 years ago. And so my dad was like the typical person that was, you work hard, your word is your bond, but he also said things like, hey, we can't afford this. We think I am made of money. Money doesn't grow on trees, all those kind of favorite sayings you get growing up. And so the one thing that hit me the most though, is he would always tell me, he says, Chris, my job will literally kill me. I'm going to die working, because the stress from his job was getting to him so much. He'd already had strokes by his 40s and heart attacks by his 50s. It's a freaking miracle he's even alive today in his 80s. But yeah, he was definitely in a place where he was having a really, really hard time. And so I thought, as I went to college and I was looking to start a business, because I realized being a business owner was the one way you can actually create real wealth faster. I thought, what's business I could start up? Well, when I found being a financial advisor was some way I could start a business and get things going, I figured worst case scenario, I learned about money for myself. Best case, maybe I'd give my dad a few years of his life back. Maybe I can give him some hope. So I did that for 4 years. And then after 4 years, my dad said, when are you going to sit down and work with me? When are you going to become my financial advisor? So, as a snotty little, 28-year-old kid, I think I'm a snotty little kid at 28, but I know that's technically an adult. I sit down with him and I look at all his finances for the first time in my life. And I saw that he was stuffing money in his 401k, getting the company match. He was 100% debt-free, including his mortgage. He actually paid off his mortgage in 18 years and was very proud of it. This guy was basically like the Dave Ramsey poster child, if you were to put it this way, even though he was pre-Dave Ramsey days. So anyways, I'm looking at all his numbers and I said, Dad, you're 61 years old. If you want to retire today, you better hope you die in about 5 or 6 years, because that's when you're going to run out of money. poor Mike's laughing at that. You're so morbid, man.
Well, I'm coughing. I had to cough.
Oh, okay. I thought you were laughing just now.
Yes, it had a little bit of a irony. In order for you to have enough money, you got to die in 5 to 6 years.
That's right.
Otherwise, boy, that's a tough sled from there.
Yeah, well, it's almost like you have to live on rice and beans, right? In order to actually, maybe not rice and beans is too expensive. You have to just live on ramen, and then you can ensure that you only live 5 or 6 years if you do that. And that's definitely not the thing he wanted to hear, and it wasn't the answer I wanted to give him. And so I was bothered by that. I realized that I had become a salesman in a suit. I was a guy trying to sell people these dreams, selling them hopium, as I like to call it, right? Like, you hope you're going to be able to retire someday. And even though it wasn't like he didn't save enough, this guy was saving a lot. If he had, even sitting down with financial advisors, he was doing according to their plan. It just wasn't enough because the market wasn't performing well, because he had like Y2K that took money away. This is also a few years before the Great Recession. So you can imagine, the market is just recovering. And yet I still had to drop that bomb on him. And so that's where I got into real estate investing instead. I started looking for where actual evidence worked, and the things that you're seeing about here with alternative investments. That's exactly what world I got opened up to that I had no clue even existed when I was a financial advisor. And so I quit. I would never teach about money again. I would just, do mortgages on the side and be a ballroom dancer, a ballroom dance instructor on the side too. And so I was doing that kind of stuff. And then later that next year, as I started learning about how to really invest for cash flow, I was able to retire when I was 28, almost 29 years old. And that's where I realized there was a big contrast, because I was hoping and praying I could save up enough money by the time I was in my 40s, have a couple $1 million in my mutual funds, and then I can live on to the interest at like $60,000 a year. But I was able to do it faster by getting my money to work in better places, because it was always about that income, not about just compounding interest. It was compounding income instead. And so that was kind of my story. That's where I kind of came out of retirement to do so. But here's the thing, guys, like, there are a lot of issues going on right now. You almost have to turn off the news just to stay sane, don't you? We've heard enough about freaking, Elon and plane crashes and everything else, to go on in the world. Not to mention, like, people keep saying like, yeah, the market's up, but how long? Like, it's been up forever, right? At what point is it going to start dropping finally after 16 years with only one down year in those 16 years since 2009, right? All this stuff is happening. People are starting to question that. What about the government, right? Oh, so we got Doge trying to help find ways to free up money, but they can't find enough there. Or if people keep roadblocking them, who's to say they're not going to go after your IRAs and 401ks anyways? We got interest rates. We don't even know what's going on with that. They're supposed to be coming down, and now they're not, right? And we got Warren Buffett selling off his Bank of America stock and Apple stock, right? He's selling those things off. Makes you kind of wonder, what is he preparing for? And by the way, he's now got over $325 billion in cash, just sitting around doing nothing, getting ready for something big. Why do we keep throwing our money in the market if we know that even Warren Buffett doesn't want to keep his money in the market, right? Not to mention, Vanguard came out. They said their expected 10-year return on the market is going to be between 2.8 and 4.8% returns. Is it no wonder why we're seeing treasury yields go up? Because people are saying, wait, if I can make more money in treasuries, I might as well put my money in someplace safe versus gambling in the stock market to maybe make between 3 and 5%, if I'm lucky, per year average over the next 10 years, right? That's the kind of stuff we're dealing with. And we got, of course, banks that we've had all these banks fail and then they didn't. Like, well, how do these random banks fail? What else could be happening down the road, right? I love this little Simpson, meme here about the FDIC. Is like, we've lost 2 banks. Like, we've lost 2 banks so far. Is there more stress to come that we haven't seen yet? Well, what I am talking about here is unbanking yourself. Doing something like Walt Disney did, where Walt Disney actually was able to get enough money for starting up Disneyland, right? He had to have ABC come up with money, but he had to come up with his own cash. He actually leveraged a strategy to do so, to create the happiest freaking place on earth, right? We got Ray Kroc, that when he bought it from the McDonald's brothers, had to use the same strategy to be able to pay for those executives to boom and create this massive conglomerate of McDonald's, right? And so what are these tools that people have been using to make millions? And by the way, where do banks store their money? Where they actually, and by the way, just so you know, banks don't store money in their own banks. I've actually talked to people that have owned banks that refuse to put money in their own banks. Why? Because they know that's not even the best place to put it. They do it with this, which is infinite banking. It's kind of the topic of today, and really the wealth wheel of how this all works together. I will just say this, infinite banking, when we talk about this today, this is not the answer to make you financially free. This will not solve it for you. But when you use it hand in hand with something like what you're learning with tempo funds, right? And where you're using it with alternative investments, when you use it together, it's like that peanut butter and chocolate. You put them together and you get that Reese's peanut butter cup, right? You put those 2 things together, it becomes even better. It's like better than the sum. And that's really how this works. It really just throws gasoline on the fire, help you get there faster. So here's the wealth wheel that we're talking about here today, right? And how this all fits in. First and foremost, you got to have the right education and mindset and perspective around money for money to work harder for you. Because the problem is you've been brainwashed for your entire lives. I know many of you guys have broken past this because I can see some of you guys on right now. I know some of you have been clients of ours. And so I know you've already gotten that education. You're already learning to look at money in a very different way. And as you do that, as you start to focus on not just lock your money up in prison, set it and forget it, right? And lock it up in those 401ks, you're locking up in house equity. So it just sits there and does nothing. And then you can't get to it unless you have to either quit or get fired, or you have to sell off a house to be able to get the equity out, because if banks change their minds, you won't be able to cash out, right? Get that money back in your control, get it liquid. This is one of those strategies of where you can hold that money to stay liquid. Then that money doesn't just stay there, it doesn't just sit there, but it can actually be used in creating passive income, using these investments that generate those incomes. And then it keeps cycling through to, instead of compounding your interest, although you might be doing that with your self-directed IRAs with Tempo, but instead you're actually trying to compound your income. You're trying to compound those results to ultimately have more income at the end of the day, like what my dad was hoping for, but didn't get. And just, you know, guys like Dave Ramsey just don't get this stuff, right? And even if they did, for whatever reason, he doesn't want to see the truth. You know, he wants to just keep teaching the same thing he taught 30 years ago and thinks that the market still returns 12%, which is a bunch of BS. That's not true at all. By the way, I did redo the stock market average for the last 30 years. The SP has now averaged 8.75% in 30 years. Best I have seen it in 20 years as an average now. Just so you know, the strategy too, Eddie Wilson, a friend of ours as well, has actually used the strategy, not just for himself, but he learned it from his grandfather who owned a bank, who taught it to his dad, who taught it to him. He's been using this to buy and sell businesses for hundreds of millions of dollars as well to create wealth today versus just hoping someday they'll have money tomorrow. Now, I'll just tell you this, not all infinite banking is made equal, okay? If you hear about infinite banker out there who's becoming your own banker, it's one of the kind of like the Bible, so to speak, of like how infinite banking came to be popular. He wrote this back in the 90s. The thing is, these are not all the same. You know, I'll give you an example here, and I'll tell you kind of about my story, but, you know, I bought a traditional policy. Here's one. This is not my policy. This is actually one where somebody had sent me this Northwestern Mutual policy they had. They said, hey, they're telling me to put in over 22,000 a year. Look in year one, you'll see right there, $446, right? So you're jumping in like 22,000 a year. You're like, well, when do I actually finally have the same money I put into it? You know, for this person, unfortunately, it takes you 13 years to finally have the same money you've put into this policy. You know, yes, you get a death benefit, but here's the thing. This thing about infinite banking, right? We're using whole life insurance. That's the vehicle that we're using. But again, whole life can be designed in so many different ways. And if you're not sure about this or you haven't heard about this, whole life insurance is different than term insurance. Term insurance is just a death benefit. Whole life insurance has that death benefit, but it also has this tax-free savings account inside of it that also accumulates money. So it's more expensive, as they say, because you're building up a tax-free savings account while also paying for a death benefit. And in some ways, it's kind of like saying, rather than buy term invest the difference, I'm going to try to see if I can pay this now and then have more money than I would just doing buy term invest the difference. But unfortunately, most of these insurance agents, they make money off of this and they don't design it the way that they should for two reasons. Either one, because the insurance companies don't want them to learn this way, which is usually true. Or two, it's because the insurance agents know that if they find ways to cut back fees, they don't make as much money. And because they're not financially free, because they're not investing, they need the cash, every dollar of it. And that's where you suffer. Your family suffers because you get less where they can get more. Just so you know, same example, I ran one for someone to show apples to apples. They would have 17,000, not $400. So big difference. We'll
Chris,
talk
can I
about
add
it more.
one comment here? Go
Yeah.
back to the previous. So I'm the victim of that classic theme on the left with the insurance agent selling a traditional policy to my family, and I didn't know better. So once you sign up, you sign up. It's exactly the case. These traditional policies are premium that the commission have in the first year.
Yeah.
So by selling a traditional policy where the cash value at the end of the first year is low, the agent makes the most commission. And the policy on the right that you design works way better. So live and learn. Sometimes you get one of these wrong policies and then you realize, wait a minute, but you can't go back. I mean, you're stuck in the contract. This was a 20-year pay, which you're sort of showing here. So ultimately, the design on the right is far superior. It's less attractive to the agent, but much better for investors from the cash value and availability of cash, especially in the early years. So yeah, I could just attest that I saw the thing on the left. This is very real. Most insurance brokers offer thing on the left because it's just more lucrative to them, with all due respect to the whole industry.
Yeah.
I want to comment one thing. I signed up for a policy just recently, and I was shocked how fast I got an email saying, are you ready to put it to work and start investing? I was shocked because it was just a few days.
Yeah.
And it was like, okay, now put it to work. And so it doesn't take long to be able to use this policy in the way that it's meant with what Chris does.
Yeah, in your case, especially if you're healthy, like they just approve you right away. I mean, I'm 47, like I'm older, and still, just because I haven't been to a doctor in like 10 years, they're like, all right, there's nothing to look at. Approved 24 hours later, right? But so it's kind of nice. I don't like doing the poke and pee test. I'm not a big fan of needles, you know? So if I can avoid that at any cost, I will try to do it.
Yeah, that was my number one scare. And I was so relieved when I didn't have a test at all. I was shocked actually, because my term life insurance policy did require all of that. and it was a lot smaller than this one. So
Yeah. No, you're one of the 35% that got to avoid, having to do the little test. So that's good. So, but yeah, like I mean, I'll just kind of give you guys a secret of how is this different? How does it work? Honestly, it's really about pulling different levers to lower the cost of the policy. And so, the cost of the policy is what pays the agent, right? Like that's how they make the money. So for example, the one on the left, that Northwestern Mutual agent, they get paid a percentage pretty much of that $22,000 because there's no cash in that first year. They're making whatever percentage they get paid off of that 22,000. The one on the right, showing that same example, that 22,000, like you have 17,000 there, is because you only get paid a percentage of the less than $5,000, right? That's one reason why the agents won't do it. It's because it does cut their commissions back by like 75, 80%.
Yeah, isn't that the first year? I may be wrong.
That's just the first year. Yeah.
What I learned is it's like 3/4 of your premium, your 22,000 you contribute here in this example, goes to the agent commission. So the difference between 3/4 of 22,000 versus 3/4 of like 5,000, it's pretty significant.
Oh yeah, that's huge. Well, and even I showed like down the road, like what was it after, well, even if you look at 13 years, like in the one on the left, he finally hits 289,000 after putting in 287,000. The one on the right, that same thing, I don't have it highlighted, but it looks like it was 374,000. So there's already like almost $100,000 more. And the thing is, people say like, well, my agent told me that's the best design is do it this way on the left, like Northwestern says. No, it's the best for the agent, not for you. Because I haven't seen one reason saying, oh yeah, I should have less cash. It's just ridiculous.
The only, I don't know if you want to call it saving grace is for the agent is the death benefit typically on the policy on the left is higher at the start. So if you could see
at the start. Mm-hmm.
Yeah, at the start. So the idea is it saves as a mix of term policy and a saving mechanism. But the reality is you're better with the infinite banking greater savings, and you can buy additional term policy to give you additional death benefit if you need it. So that combination works way more effectively and efficiently than the policy on the left, the classic policy.
For sure. Actually, you've noticed after 20 years, like I actually highlighted there the death benefit and the cash value. So they had 1.3 million death benefit. Of that, there's 575,000 of that tax-free savings account. On mine, on the right, they have actually almost $1.5 million of death benefit. So the death benefit actually grew to be bigger than theirs eventually, right? And you have 714,000. So now you have about $140,000 more by that point, And the cool thing is you're not required to have to pay 22,000 every year. That's the other thing too, is that whole life, one of the biggest critiques is it's not flexible, right? It's expensive. But what I remind people is in this example here for this person, the minimum is like $4,500 a year, but they could put in up to 22,000 a year. So there's a lot more flexibility for, life, right? Because as one insurance company says, life comes at you fast, So, we want to make sure you do that.
Yeah, it's a critical point. The beauty about what you just said is huge. Basically, policy on the left, it's a 20-year pay, completely inflexible. You got to make the premium, otherwise you default on a policy. You can lapse the policy. The policy on the right, if you have a tough year and you need to preserve more cash, and contribute less, you have that option. It's a huge flexibility option, and ultimately the policy on the right gives you higher cash value and also higher death benefit. This is almost insane if you look at the numbers. How the thing on the left gets sold because it works much better for the agent, and the policy on the right, custom designed the way you do it, benefits the policy owners, the infinite banking, investors way better.
That's right. Exactly. So that's the thing that's kind of interesting. And some people say, well, is it just the insurance company? Well, the insurance company can allow you to have different levers to pull and do it better. But I'll tell you, I just ran a situation last month where it was with an insurance company that I often use. I know it's the same one you use, Deanna, right? This guy was another insurance agent. He just said, hey, I don't write with this company. How does this one look? This one was putting in 60,000 a year. Once again, see this one on the left. This is the traditional whole life plan. So that one with Northwestern, they gave you a little extra few bucks there, but not much. This traditional whole life plan, they're putting in 5,000 a month or 60,000 a year. Notice after year one, because they'd already had it for about a year, zero cash. Next year, they put another 60,000. Now they're 120,000 out of pocket, zero cash. Third year, they did another 60,000. They finally have 30,000 of cash, right? And I told him, I was like, oh, can we do better? Yes. And I said, this same woman, assuming the same health rating she got already last year at the same company, this is what we would have done. It's like, look, she put in 60,000. Day one, $50,745. So we would have saved her $50,000. Crazy thing is that even by year 5, she put in 300,000. She still has 308,000. That other one, she had 156,000. So like it's already $150,000 difference in just 5 years. It's just crazy. So now I know for some of you people, you don't want to go cross-eyed, but this is why I kind of got inspired by doing this. Because remember, I quit being a financial advisor, then go do real estate investing. Well, all these real estate investors were bragging about this infinite banking thing. That's how I first heard about it. Never heard about it as a financial advisor, but I did when I started talking to these real estate investors. So I met with this guy. He told me, hey, you just put in, so many $1,000s a month, you do it for, the next several years, you'll have cash. And I said, well, look at it. Like, this is really expensive up front. And I would remember I was insurance licensed. Even at that time, I said, are there levers I can pull to make this cheaper? He said no. He flat out told me no. 2 years later, the recession hits. I go from millionaire to upside down millionaire, right? Because real estate's suffering. I had started a new business with some partners who were also marketing to real estate investors that were going broke. So our company was going broke while I was personally going broke. It was like this double whammy. And I couldn't afford to keep paying the premiums because I had to pay, in this case, it was like $1,000 a month is what I had to pay into this plan. I didn't have it. So I lost the policy. I paid 25 grand into it over just over 2 years and had nothing to show for it. Several months later, I spoke with a friend of mine who also bought the same kind of policy and lost it as well. He said, you know what? I just found out you can actually adjust these things to make it, more cash rich. I said, wait a minute. Are you sure? Because he told me no. He's like, yeah. So I started to do my own research. Remember, I was insurance licensed. So I decided to do my own research instead of trusting the guy that I trusted. I went and did all the numbers, found out this guy was wrong. So I went and I confronted him. 2 hours I sat in his office. It got to the point where there were some elevated voices. I don't usually get angry and loud, but I started to get a little bit angry and loud with him. And finally, at the end of those 2 hours, he said, Chris, I did it this way because I couldn't afford to cut my commissions. I said, well, there's the problem. And I vowed, I was like, never again am I going to send him any more of my friends or family. Like I'd already sent him probably tens of thousands of dollars of business already to that point. I was like, no, never again. And so I kind of went on a mission to find ways to make it better, right? To do it in the way that me as an investor would want to do it as well. And that's really what we started doing, perfected over time. That's why it's so good, is because we spent so many years, really now going on, what was that, like 2008 when I had that conversation. So, I mean, since then, now what, 17 years, been trying to refine it, make it better. That's why sometimes I refer to it as no BS infinite banking, even though we have trademarked max ROI infinite banking, because I'm just tired of the BS out there, right? It's like, it should just be what you see is what you get. By the way, if you ever get somebody who shows you numbers on video or whatever it is, but then they don't send them to you until after you do the policy or after you get approved, that's a complete sales tactic to try to get you committed. Don't fall for it. It's just crap. Now, it's not for everybody. I'll tell you that much. There are 3 situations where I'd say that this would not work for you. 1, you're paycheck to paycheck. You're probably not even on this if you're paycheck to paycheck, but if you're like literally can't have, you can't put away at least $5,000 a year, I wouldn't do this. I would just do term insurance. And you, by the way, if you can't even afford it, you could always do a convertible term policy that you could convert to whole life later on and not have to re-qualify on your health. So I actually had a woman who did that. The next year we went to go get a policy and all of a sudden she was uninsurable for whatever reason. She was even in her 30s and she was uninsurable. But because she had that term policy, that same day she got rejected, she got declined for insurance. I went back to the insurance company and said, all right, we're going to convert this term to whole life at this top preferred plus health rating. And they said, okay, she's approved. Even though they knew she was uninsurable, they had to honor it because it was a convertible term insurance policy. And just so you know, just because you have term, you may not want to convert it to whatever they offer. Most term companies are not good that way. So 1, if you don't have at least $5,000 a year, do term. 2, if you're over the age of 70, you could still do insurance, but I wouldn't do it in this way of trying to use it to invest. It would be more for trying to, help your estate, pass on, estate planning type of purposes. 2, or 3, I should say, I can't count apparently. 3, if you're in bad health, if you're a smoker, you might be able to get with it if you're in decent health. But if you're in bad health where you just had a stroke or a heart attack recently or some cancer or something like that, well, then it may not work for you. But kind of go along with whether you're older than 70 or even if you're in bad health, if you have a family member that is in good health, this could work. I had one client that I know Mike knows as well from years ago, that he was a dentist, was very overweight. And he said, Chris, I know even if I get approved, it's not going to be pretty. He's like, well, could I do it on my wife? I said, well, is she in good health? He's like, oh yeah, she works out every day. She's in great health and she's younger than me. I said, well, that's 3 good things. Because 1, she's in good health. 2, she's younger than you, but 3, she's a woman and women actually get better ratings because they live longer. So that's even better. So let's do it. And so he started packing in $110,000 a year into his wife's policy because he knew that would be cheaper than using his. So sometimes you can do it on your family members, it could be partners, key employees. It could even be on like kids, children, even grandchildren, things like that. You can do it for. So
let me ask a tough question.
Yeah.
You have family trust as a beneficiary and the kid is the insured?
Definitely. Absolutely. Yeah. I actually have a slide on the very end of this. I'll talk about that a little bit, but yeah, absolutely. You can definitely have the family trust be the thing that it pays into. A lot of times I'll just have the spouses be their own beneficiaries because, you could pass on unlimited amounts of money to each other tax-free. But when you pass your kids, that's when all the taxes start happening. So, but yeah, you can still put in the name of the trust even if you don't want to put it in your spouse's name too. Major benefits, like I said, is tax-free, much like a Roth IRA. If you put it with after-tax dollars, it grows tax-free, comes out tax-free. The benefit though over a Roth IRA is that like this, there's no dumb limits or penalties, right? You don't have to wait till you're 59 and have to use it. So if you have a goal to try to retire before 59 and a half, this can actually be used as tax-free retirement income down the road. Even though I don't necessarily teach it for that purpose, that is an option you can do. You can pull out that money anytime you want during the first year even. You don't even have to wait. There are policies and people that will set up policies that make you wait 1, 2, 3, 4, 5 years out. you don't have to do that in the way we designed it. You can access the cash like the first month. But yes, you can actually access that money. There's no limits in the sense that if you make too much money, they won't let you contribute. That's not the problem. In fact, the more money you make, the better. And you can put in up to 25% of your stated gross annual income. I just ran a situation this week with someone who's like a CFO, and she's like, and she had claimed that they made 210,000. She was just putting her salary, but she wanted to put in 60,000 a year. And they said, well, that's too much. You can't put in that much. I said, well, I know you guys make more than that. I said, well, we just put on what would be like the salary we would show by documents. I'm like, well, they don't ask for documents unless you're trying to do an obscene amount, like put in $1 million a year or something like that. They're not even going to ask for documents. Put in all your gross income, even before all the tax write-offs, because obviously you're a business owner. Put in all. And they're like, oh, well, we make 350 or 400,000 a year. I'm like, great, put that. And so they did, and now they're getting approved for 60,000 a year. So that's the thing. Like you put up to 25% of your stated gross annual income. I even have a real estate investor. He's a syndicator. He claimed he only showed 25,000 on his tax return because he had so much depreciation from all the multifamily he did. And but he made about $1 million a year. He's now putting in $250,000 a year into his policy. So and there's no penalties for accessing your money early. Nothing like that. No 10% penalties for early withdrawal. None of that stuff. I mentioned it's protected from lawsuits of creditors. That's 100% in most states. So most states will protect you. Even if somebody sues and wins, they cannot get to this money. They can get to your savings account. They can put liens on your house. They can do almost anything, but they cannot get to this money. If you're in California, sorry, you have limited protection in California because California sucks sometimes, especially when it comes to lawsuits. They're safer than the bank. Why do we say that? Because we all hear about FDIC. It's supposed to be the thing that makes it feel warm and fuzzy inside. But did you know that FDIC only has enough reserves to cover 1.5% of the savings accounts out there? So what happens if 10% of banks fail for whatever reason, we have another financial meltdown? Where's the money going to come from? Not the FDIC, right? They're going to be scrambling just like we saw in 2020 when they're trying to figure out how to give us these EIDL and PPP loans and stuff. They're going to be scrambling trying to figure out how to get you money. That's what would happen. Here with insurance companies, one, they don't fail like banks do because they can't go and over leverage and go into major debt like banks do. But two, even if they do happen to fail, they are all required by law to buy what's called reinsurance, meaning that if they ever fail, another global insurance company will come in and protect your money and your death benefit. So it's all protected that way. And by the way, they have guaranteed growth on this. Usually at least 3% is the minimum guarantee. However, we use companies that have been paying for at least 175 years straight. That means since pre-Civil War, they've never missed paying more than their minimum. Right now, they're paying 6% a year or more currently. Of course, protects your family and your legacy. That's always a thing with the death benefit. But again, the biggest thing is access to cash now. Here's how you can use the policy, right? And again, if anything's not clear, be sure to put that in the chat or in the Q&A part if you have questions for sure. One, I use this first and foremost as my emergency fund. I realize that, especially with inflation having been pretty bad the last few years, my wife says, Chris, I want $400,000 sitting on the sidelines that you do not invest. We don't invest it at all. We don't use it for business. It's just literally there to protect our family. Well, if you do the math, my credit union pays me a whopping 0.1% a year on my savings account. 0.1%. That means I get paid $400 a year on $400,000, and then I have to pay taxes on it. So I might walk away, if I'm lucky, $300 a year that I make. So I told her, I said, listen, why don't we diversify? And by the way, she was a former Dave Ramsey instructor, right? She was one of his counselors. So she was anti-whole life. And I said, what do we do? What if we do this? Because she's like, we got to put money better. Like even the high yield savings accounts currently are only paying 3.5%. I said, well, over here, I can get 6% tax free. Why don't we put 300,000 over here, have it earmarked just for that? We don't invest it. Now we're making 6%. That's 18,000 a year we're making tax free versus $300 after tax. And we still have money in the bank. We still have money in high yield savings accounts that we can access quickly, but I know I can get to that money in my life insurance within about a week or so. So that's where I'll put the lion's share of my money to go and make a higher return. I mean, that alone for you guys should be worth it, right? Especially if you're trying to have an emergency fund that's decent sized. Collateral. This one's one that most people don't realize. Remember I mentioned Walt Disney. Walt Disney actually put up one of his houses, his vacation home, and his life insurance cash, not the death benefit, but the cash value, that tax-free savings account, as collateral. So then ABC would come in with the rest of the money to then fund Disneyland, which they thought was a big gamble, right? ABC, the only reason they did is because they were floundering themselves. So they were really gambling on something big here. So you can use this collateral. I actually had one client who was a chiropractor that was going to buy his own practice, his own building, right? Building for his practice. And it was $375,000 if you include build out. He said, hey, Chris, I've got this old life insurance policy. It's got $300,000 sitting in it. Should I just cancel it and just pull the cash out and use that? I said, hold on now, before you do that, instead, why don't you actually, let's talk to the bank, see if they'll give you better terms by putting this up as collateral, this insurance as collateral. So he did. He went to the bank, says, hey, in addition to the building, can I put up this $300,000 of insurance as collateral? And the banks started frothing, said, yes, absolutely. We love double collateral. And in fact, we will give you not the standard going rate over 6%. We'll give you 3.75% on your mortgage rate. So he ended up only paying $1,875 a month, which, by the way, once he did the build out, got a renter more than paid for his building. So now he's in his own building rent free for his practice. Although for tax benefits, he's still paying himself rent so he can make some money, right? He still did that. But then after a year and a half, he went back to the bank. He said, listen, I think there's more enough value in the building. Can we take the lien off my life insurance now? And they said, yes. So they took the lien off, but they left the interest rate the same. The terms are all the same as if he had it there the whole time. And so now he had the 300,000 that's now left to go invest and do whatever he wants, but he was able to get a much better rate on his building. So many cool ways you can use it that way. I already mentioned retirement income. Like I said, you can pull out tax-free retirement income at any time. A lot of people even use this instead of waiting, especially if they've got Roth IRAs or 401ks, they'll use this first to then retire by the time they're 50 and then use this for those 10 years and then start tapping into the Roth IRAs or 401ks. So great way to do it that way too. And it's a very certain secure place, you can pull out money. Usually, by the way, where most time retirement income, you're told in mutual funds not to pull out more than 3% a year. Here, you can usually pull off about 7 or 8% a year and have it last for decades because again, it's just very boring interest rates. They just keep paying very consistently. Kids savings, that's another one. So many people have been hating their 529 plans. People have been switching over to this instead because what if your kid gets a full ride scholarship to college? What are you going to do with that 529 plan then? Like if you try to cash it out, they're going to penalize you for trying to cash it out, for using it for anything besides college, right? What if they decide not to go to college? What if they become an entrepreneur instead? This can actually be used as a kid's savings, but you control it. It's not in their name. They can be the insured, like Mike was just saying. You can make the kid the insured, but then you own and control the policy. It's your money. You can do whatever you want with it. Even when they turn 18, they have no claim on it. So you can keep it forever, or maybe down the road, maybe if you feel like, and I know this because I have a blended family of 8 children, every child is very different with money. Some I would trust over others. But for the most part, when they turn 18, 19, like I have a few of my kids that are, I wouldn't dare trust them with any of this money. So instead, I'd rather wait till maybe they're into their 20s or so, maybe mid to late 20s when they start to, their neurons start, synapses start connecting the dots a little bit more, then finally at that point, I might say, hey, you know what, to give you a good start on life, maybe we give you some money now, maybe help you get in that first home that's so unaffordable for like Zoomers and millennials right now, right? What if it's money to help, right when you get married and get a good start in life? It could be something you pay for college too. But hey, why not get the interest, possibly the interest deferred student loans in the meantime, and then use this? Oh, bonus thing. This money does not count as an asset against your kids when they try to get financial aid from colleges. So you could literally store millions of dollars in here and they won't count as an asset. See, that's why they also don't count as an asset if you get sued, right? They don't count as an asset there either. But the one place it does count as an asset, which we love, is with banks when you're trying to get a loan, because they do count as an asset as a liquid cash reserve. So I actually saw this as a mortgage broker all the time. In addition to savings and money market accounts, this cash value life insurance was the thing you could actually count as savings. So even when I try to get a loan, I don't even send them my bank statements anymore. I just send them a statement for my life insurance, say, here you go. And they go, check, reserves done. So it counts when you want it to count, but it doesn't count when you don't want it to count. And then this one right here, cash flowing investments. And I know we're kind of getting short on time. I'm going to breeze through this, but this is the big thing. Why people say, well, how do you make money twice with this? This doesn't make sense to me. Well, we all know Warren Buffett says, if you don't make money while you sleep, you're going to work until you die, right? And I know Deanna and Mike are all about passive income. Well, what if we can get our money working harder for us, right? Double arbitrage. Arbitrage means just like the bank, when they borrow money from us, from our savings accounts, to then use it to make more interest, that's arbitrage. We could do the same thing. What if we turn the tables and we become like the bank? What if we're the ones that take advantage of these higher interests? Now, most people, when they invest, they just pull money out of savings or checking where they make no money or no interest, and then they fund an investment. And then when they get the cash flow or the returns from that investment, it goes back into that account. What happens when you drain that savings account? When you drain it to go invest in it, is that savings account earning any more interest? No, of course not, right? Because it's gone. Now you're making money in that investment, but wouldn't it be cool if you could still make money in your savings account and in your investment at the same time? That's what we're doing right here. So this is where you can actually do something different. Instead of just withdrawing money, which is always an option with life insurance, you can actually get a line of credit from the insurance company. It doesn't show up in your credit report. It's not even based on credit scores. They don't even need to know why you need the money. You can literally just say, I'm going to buy drugs with it, and they don't care. They don't ask you the reason. By the way, I'm not recommending, go along with the disclaimer that Deanna just put, we're not recommending buying drugs, okay? But I'm just trying to make a point here. You can use this for whatever you want. Sorry, Deanna. I know the disclaimer is just for me. I said it. So you can actually take out a loan from them, a line of credit, just up to 95% of whatever cash is in there, you can take out as a loan. And some people say, well, why would I pay interest to the insurance company or to a bank? You can do it with certain banks too. Why would I pay interest to them when I can just pull the money out? Well, because the thing is, when you borrow money from the insurance company, what's happening to the money that's already in your life insurance policy over here? Nothing. You're still earning interest. You're still earning tax-free compounding interest. While they still charge you a pretty low interest rate on the other end. Right now, interest rates are anywhere from like around 5 to 6% currently. And so they're charging you low rates on that end while you're also earning dividends on the other side. So they're already kind of have a wash. But here's where it really works, because there's a difference between compounding simple interest. So let me use an example here. There's a small apartment building. Say you want to put $250,000 down. Say cash flow is $2,500 a month. I know that's pretty rich nowadays. If you find that deal, you want it, right? That's a 1% a month deal. let's just say you put $250,000 down on this $1 million apartment. Now I want to compare, what if we drain the savings account and then that $2,500 a month goes back to fill up your savings account again, right? What if we did that, but compared it to using your life insurance where we don't drain the savings account, we leave it alone, but we get the money from the insurance company instead. Yes, we still have to use the cash flow from that investment to pay down that line of credit. And by the way, when I say you have to, you really don't. There is no minimum monthly payment. You pay it back however, whenever you want. Your deadline for paying back this loan is your death. Because at that point, if you die, they take that loan balance that you owe them, the loan plus interest, they take that out to pay it themselves back. And then they pay your family the rest of it tax-free. So you get the rest of the death benefit. So if you had a $2 million death benefit, you had a $500,000 in loans, they'll take the $500,000, then pay the rest of your family, $1.5 million tax-free. So anyways, so that's why they don't require it, because they already know they're paying you interest. They're not worried about you having to make payments on this. So it's very flexible that way too. Yes, they do charge you interest, right? But what if we use that cash flow to pay towards that line of credit, just like you would use a home equity line of credit, but it's like a home equity line of credit that pays you interest, right? And so you use that money to pay down that line of credit. What happens to the interest you're getting charged? It goes down over time, doesn't it? But the money that they have in there that you haven't been touching has been compounding the other direction.
I'm curious, just a quick question.
Yeah.
If you borrow against a policy,
Mhm.
what are the interest rates today typically on a loan against a policy versus if you were to try to borrow from a bank today? I'm just curious.
It depends on the company. Like one company I use a lot of, they have the loan rate at 5.3% right now. Some, like I know, like Mass Mutual might change it soon, but like, they've got theirs over 6% right now. Some of them have less, some of them have more. But bank rates, they're all based on prime. And so I know one bank that I use, they're now at 6.5% if you have over $250,000 in there, or about 7% currently. So they're still pretty cheap even with the bank. But if the feds start lowering rates even more, I'm probably gonna start telling our clients, switch from using the insurance company to back to the banks. Because 2022, I had a 3% line of credit with the bank. I mean, you can imagine, like, they're paying me like 5.75%, but that's why I'm getting paid in interest. But then the interest they're charging me was only 3%. That was like a no-brainer.
Yeah, exactly. So exactly the point that I wanted to bring is that
Mhm.
today, if you have a policy, it makes sense to borrow. It's
Mhm.
infinite banking, self-banking. You're borrowing against your own policy, and the cost of that borrowing is lower than if you went to the bank today. When the interest
Yeah.
rates drop, you can go back to borrowing from the bank. Exactly.
Yeah, you played a little interest rate game, right? Yeah, exactly. I'll tell you this though. Here's what's interesting. Like with this example, like if you just use a bank savings account, earning that 0.1%, like my bank's paying me right now, after taxes, I would earn $1,200 over 9 years, even after paying in $270,000 over those 9 years. But if I use my insurance company, my own insurance policy, and I actually use my real numbers, and by the way, just so you know, this insurance company, you actually have a 0.65% spread where the loan rate's 0.65% higher than the rate they pay you. But guess what? Even despite that, but because I'm paying down the loan, I still net, after paying them interest and insurance costs coming out, I still net $126,000 versus $1,200 of interest over those 9 years. I mean, that right there is like a whole nother investment that can generate more cash flow right away. So when I say you can shave off years towards retirement goals, this is why. Is now your money's just working harder for you by using the strategy. Now, if you didn't ever, like, if you invested money and then lost it in the markets or lost it in some deal, yes, of course, like, it's not going to work, right? You're not going to see yourself getting ahead. The way that this works is if you're taking the returns from investment, even if it's like quarterly dividends or whatever it might be, cool. Maybe it could be annual, right? It doesn't matter. Taking that money, paying it towards that line of credit, you keep the money from compounding against you, while on the other end, they're compounding interest that they have to pay you, right? So that's the difference right there. Even if you have a higher interest rate, right? That's how you make money twice, right? You can actually earn money in two places at the same time. So again, coming back to this big picture, and that's kind of what we're going to finish up on here. I'll put up a little QR code if you guys ever want to reach out for questions or see how this works. But yeah, this is how the whole wheel works, is that we get that infinite banking to earn us more interest, give us more money to invest passively, and it keeps cycling through over and over and over, accelerating your way towards financial freedom. So I'll get to the consult just a bit. Best ways to fund it. People ask me what's the best ways to do it. Years 1 through 3, when there's those net costs that come out, I just tell people use your emergency fund. Just like you would move money from emergency fund to a high yield savings account, made from a bank to a high yield savings account. Same thing. If you're keeping 100,000 in an emergency fund right now, you might say, well, let's put in maybe 25, 30,000 a year that we start using from that fund to fund into here. So then it starts moving over. And then you invest all the money you're going to invest anyways. This is the one thing I don't like taught out there about infinite banking. And some people say, throw all your money in here. They see that double dip thing. They're like, I should put all my money in here and I should invest all of it. And my answer is no, I don't think so, because your money doesn't just work one dimensionally, right? There's multiple dimensions to it. There's always these things working together. And so I tell people, no, like I had somebody who had like $250,000. And they're like, well, should I just throw all 250 in here? I said, well, no, because if 20% is going to go to cost, you'll only be left with 200,000 to invest. So don't do that. Instead, let's maybe do 50,000 a year, right? Instead, put in $50,000. You'll still have 40,000 that's there in reserves. But instead of using the 250, just use your emergency fund to fund it. That's the full 250 can now be invested, and use that to invest and make your 10+% returns or whatever you're going to try to get, right? So that is where I tell them to do is like, no, don't slow your progress down by trying to fund this and try to use it right away. No, just use your emergency fund to fund it for those first few years. Invest all your money now, earn the cash flow now, the returns now, so you can accelerate your progress. And then guess what? And just like I told him, I was like, you got 250,000 that's now paying you 25,000 a year or more if you compound it. Guess what? Now you can actually use that money to go back in the policy when it's going to grow by more than whatever you put in anyways. So that's what I tell people to do.
Let me ask a question. There's actually a question in the Q&A session. It's related to this.
Yeah.
So what you're saying is obviously diversify and use a portion of your available cash to set up a policy. And then the question is, when do you set up the next policy, another policy? Because basically, under what conditions you feel like you should be ready to do another policy? That's the beauty about this. You don't have to have one policy. You can have multiple policies.
That's right.
So under what circumstances would you start or consider setting up another policy?
Yeah, that's a great question. By the way, he's got a testimonial coming up in a slide here too, which is ironic. So he's actually here. So good to see you, Christopher. Yeah, so the answer to that question is when you're ready for it, when the cash flow necessitates it, right? When you've got more cash flow, you're saying, well, I got more money I'm putting away, especially as you're building cash and trying to use cash, get another policy at that point. So like I said, like here's the thing with our policies that are different is that you can always pay less into them, but you can never pay more. This kind of goes on with what that guy told me, but he set up to where I couldn't pay less either. I couldn't pay less, couldn't pay more. I had to pay $1,000 a month, right? Well, ours is no different. So we set that max. So if your max is 25,000 a year, that's the max you put in. You try to put in a couple pennies more into it, and it's going to trigger taxes on those gains. And so if you want to keep it tax free, don't do that. You just set up another policy. Could be on you, could be on a spouse, could be on children, could be on whomever, partners, whatever. And again, it really comes back to cash flow. Like if you get extra cash you could be saving, rather than trying to put it into the bank, this money could go here instead, right? And that's what you see. So even as people start growing their accounts, they start building more cash flow that's coming in, they're going to say, now I have more cash flow. What do? Put it here. I had another guy, he's got a testimonial here too that I know Mike, you've known for many years too, and he's in masterminds with us. He was actually in one of those masterminds saying, hey, Chase Bank, I've got millions with them and they treat me like dirt. Like, where can I keep my money that I'm going to earn better returns? And I know I can, have better control too. And I said, well, you already are putting 50,000 a year into one of your policies right now. Why don't you just do another one? And so he did. He starts putting 100,000 more into another policy. So he's doing like 150,000 a year between two policies, right? So it's great. But yeah, once the cash flow says I can do it, we do it. Even if somebody says, hey, I'm only saving 20,000 a year because I'm max funding my 401k. Okay, good. Well, then I would probably put the max on a policy, no more than like 15 to 18,000 a year, knowing that your minimum is probably gonna be like 3,000 a year or something like that. So we try to build some flexibility so that it doesn't ever stress you out, So yeah, great question. So, I mean, this is kind of like the whole way of showing that wealth wheel in a different way, but it's just, you have the policy, you fund it with savings, eventually you start investing for passive income, use the cash flow to pay down those loans. And then of course, as you pay down the loan, the line of credit frees up more cash to use it again. Just like I said, like a HELOC, like home equity line of credit, but it pays you interest, right? So this was actually a couple of these guys actually are dentists, saved them shockingly $2.25 million over 20 years. He'd already had infinite banking policies. I actually wasn't going to do anything with them. I said, you've had them for 6-7 years. It's probably fine. But he said, well, Chris, can you at least double check? Can you at least review it? See if you could do something better. So I did apples to apples because if you have money in another policy, you can tax-free exchange it. They call it a 1035 exchange, kind of like a 1031 in real estate. It's a 1035. You can move it tax-free from one policy to the next. So I showed him that example, found out we would make him $2.25 million more with the same money he was putting in over the next 20 years. And they would even have a higher death benefit too. After those 20 years, it was like $4 million more death benefit and $2.25 million of cash. Needless to say, we made the switch, right?
So hold the horses here, as they say.
Yeah.
You can take existing policies and you can do this 1035 switch. Even there might be a cost of termination of one policy into another policy, or does this just happens within the same insurance companies? How does it flow? Because these policies are contracts, and the contract is too good for the insurance company. Why would they want to give you a better contract, a switched policy?
Yeah, if it's with the same company, they don't always love to do it, but they do understand. Like we had one with one of the companies we used where they actually made the rates lower over last year. So people that bought a policy back in 2023 found out like at the end of 2024 they can get a better policy. So the company's like, that makes sense. They do want to make sure it's suitable, that it does put you in a better position. So sometimes they'll ask us to send proof. We'll say, hey, can you send us the numbers showing that this puts them in a better position? And we do. Very rarely they ever ask that of me, just because we never do it unless it makes sense. But every once in a while we do that. But for one company to another company, I mean, it happens all the time. It's very common.
So you could take a look at this. Let's just say the policy was written with another agent broker. Yeah. You could still come in and look at this and say, this is a better option for you, explain why. And then the owners of the policy could say, yeah, I want to switch working with you to this better policy. And by the old agent who is earning commissions on a policy that wasn't set up the right way, right? That's
exactly
how it works.
Exactly. So Yeah, it's pretty simple to do. And there's the QR code if you ever want to book a free consult. So if you have a situation where you're like, can you review our policies that we already have? You can actually book a call. What you want to do in the meantime is ask the insurance company. You don't have to call up the agent, but call up the insurance company. So if it's like with, say, MetLife or State Farm or something like that, right? You call the company and say, hey, can I get what's called an in-force, as an IN force illustration? They'll send you an illustration that says, from this point forward, here's what it should look like. And then we can kind of compare apples to apples, say, should you stay in it? Should you not? We actually had somebody that was in a dental community that we're a part of that I looked at it and I said, honestly, no, it's not worth making the change. Just leave it alone. It's not set up great. We wish it could have gone back in time and time machine and done it better, but based on where it is now, it's not worth making the switch, right? But there's been so many other times where that's not been the case. Or if somebody's, or even if you're looking at a situation saying, oh, I'm already shopping around looking for this, great, let us throw our hat in the ring. I can guarantee 100% we will beat whatever somebody has if it's done appropriately, apples to apples. Every once in a while, I see somebody who comes back with better numbers, and I look at it, I was like, how'd they do that? And then I realized, like, oh, they triggered taxes. They had to break it for it to work. So basically, you have this taxable account versus a tax-free one. So they lied. But very rarely it just doesn't happen. So,
there's a question.
Oh yeah, go ahead, Deanna.
I was going to say, is it more suited for someone in their 30s or 40s, or is it worth doing if you're close to retirement in your 60s?
Yeah, that's a great question that came in here. Yeah, so that's, if you're in 30s and 40s, the younger you are, the better. There is no doubt. It still works even if you're in your 60s, assuming you're at least in average to good health. Now, if you're like 5 years away, it might change a little bit. So like we might say, all right, let's fund it for those 5 years or so, minimum fund it for a few more years and then stop paying. That's the one thing that's different that most people don't realize. Whole life traditionally, if you get this mainstream traditional whole life, the whole reason they call it whole life is you pay the same premium forever. So whole life is different than term. Term goes up over time because the older you get, the more expensive it gets. Whole life goes down over time. So it starts with front-loaded costs up front, like you saw before, but then it gets cheaper as time goes on. But it's supposed to stay the same premium. However, especially with the way we design it, because it gets to be so cash rich, after a number of years, usually after at least 7 years you've had the policy, you can make it what's called paid up, which means you pay no more premiums into it the rest of your life, but the cash that's in there is guaranteed to keep growing tax-free forever. So you can actually do that. So I always tell people is like, they're like, well, okay, well, if I want to do a max of 30,000 a year, like what's the worst case scenario? They're like, what if I can't pay 30,000 a year? Okay, worst case scenario is you pay the minimum, which might be 6,000, maybe 7,000 a year, right? What if I can't pay the 6,000 or 7,000 a year? What's the worst case scenario? Well, worst case scenario is if we at least have some cash in here, we can borrow from the cash to pay your premium, which is kind of like pulling out of savings and put back into savings again, right? So the cool thing is we've had so many people, especially lately with the real estate market having some stress, people are like, oh, okay, like I'm not getting paid right now. What do I do? Like, I don't even have the money to keep funding this because, my business, I got laid off or whatever it might be. No problem. Like if we've got cash in this policy, we just borrow from it to pay it right back in and it can self-fund itself really after a couple of years. So,
wow.
So there's always options. The way we design it, that's not usually the case, but the way we design it, it's much, much more flexible.
I have two more questions. So how would someone use this to invest into a syndication or a fund?
Yeah. So the best way to do it is just, if you've got the cash in there, right? Just like you saw in some of those scenarios, right? Let's just say that you've got a 200,000 in there and you want to put 100,000 into a syndication. You go and you can you can withdraw the money, but just be aware that if you withdraw more than what you've put into it, they could charge you for the extra, they could tax you. They don't charge you, but you can get taxed by IRS for pulling out any gains. So that's why we borrow. So you just, reach out to the insurance company. Often it's either through us or you can do it online. You can request a loan online. And then from there, just get the 100,000 transferred to your bank account. And then from that, you fund your syndication. So very similar to having a high yield savings account where you might have to transfer the money over from that account to your bank account. Very similar, very, very similar. Now they will charge you interest, of course. That's why I recommend when you have the syndication, as it starts to pay returns, use that to start paying back towards that line of credit so that you don't compound interest against you, right? But okay. Very simple. And then of course, when you get paid back that money, here's the other thing too. Because I had a situation with a woman where she's like, hey, my principal's coming back and I'm even get some extra interest with it too. So she had borrowed 125,000, but she was getting paid 155,000. And she said, well, Chris, should I just pay off the loan and then keep whatever interest, or should I reinvest it again? I said, well, do you already have an investment lined up? Yeah, I do. Like, well, then don't pay off the loan. If you want, pay the 6,000 interest or whatever it got charged last year, and then take the other 150,000 that's now bigger than your 125 and use that to invest in your next deal. Like just keep the loan going, so you don't have to pay off the loan. That's the nice thing.
Another person submitted a question that says, what are the limits on business deductions for interest on loans taken against the cash value of the policy for investments?
Just like any credit card you would use, if you have any interest being charged for a business expense, you can do that unlimited, right? Same thing here. Like there is no limit as well. I call that the triple dip when you're a business owner, because not only can you make money in two places at once, but then you're writing off the interest too. So you're even getting a bigger benefit than what most people get when you have that double dip effect. So yeah, there's no limit there. It's just like anything else. If you were to use a credit card, and you got whatever interest you got charged for all those business expenses, same thing here. By the way, I'll say a keynote for that. If you're going to do that, make sure you set up a policy that you're only going to use for business stuff like that, where you're going to do that. Just like a credit card, you don't want to commingle. So you're like, well, I got personal expenses that came out and I got business expenses. How do I figure out the interest I got paid on each one? It's horrible math. Do the same thing with life insurance. Just pick one policy that you're going to use for those business purposes. So then all the interest you paid is actually a write-off for you.
So would the borrower be the business?
The borrow, yeah, exactly. So you can do a few ways when you design it. Like you can just do like a capital contribution in a sense where, because again, like if you had a credit card that's in your personal name, you would still write it off, right? Now you're not writing off the premiums. Just be aware. The premiums are, you're using after-tax dollars for those premiums, so you're not having the business pay the premiums. You can do that, but if you do that, you'll actually lose tax benefits on the back end. So just be aware of that. If you try to have the business pay for your premiums, that's what happens. So I just tell people just use after-tax dollars. But then just have your business, if it has to have a contract with you, if it's borrowing from you, you can even have your business pay you the interest if you want to do it that way. There's a lot of different ways to do it, but I just tell people, use it like a credit card if you want to do the simplest way possible, which is I'm using my life insurance, for business expenses, the interest I was charged, that's what I write off.
Very interesting.
Yeah.
Well, thanks for answering all these questions. Did you have any more, Mike? I know we're kind of over time now.
Yeah.
No, just a couple of quick comments. Already folks are aware of it, and I just like how you talked about this in the past. Stuck in my head that investment in a life insurance policy, infinite banking and similar, should be considered a conservative part of the investment portfolio. It doesn't earn crazy rates of return, but it is, let's just call it 6.5%, whatever the current rate of return. And from that perspective, it's a conservative part of the portfolio with significant access to liquidity, and that's the main purpose to do it, right? It's just liquidity, and over time you get to do whatever you still want to do. You can still invest passively into income generating assets, real estate. Just the first step in the process is to set up the policy, fund the policy, get access to liquidity. And it's also a forced saving mechanism. You said at least for the first 7 years, you're forced to save and get the income on that savings better than the banks pay you. Even now, when the interest rates are high, you're earning more in a policy than the banks pay you in the best case scenario. So it's a forced savings account, and then you can tap into that capital to do things you want to do. And the final comments, all these transactions probably should require a CPA to take a look and say, yeah, you can deduct this interest or not, and how you do it properly. Probably a good CPA would be a good exercise to speak with the right type of a CPA to make sure that it's all in line with your individual circumstances.
Absolutely. Now I'll tell you, more and more I'm seeing the value beyond just that, quick turnaround for investment and passive income is that, like you said, the cash reserves part, right? Having that as part of your portfolio, like what's that stable money? The two of you, we all three of us have a mutual friend that's 72 years old. He's obviously at the point where he's financially independent, but he's like, you know what? I've got these policies from before, these old policies. He's like, should I just have more cash stored here? Like, what do I do with this thing? Should I invest with it? Should I store cash here? And he started to realize, like, when he had some, poor investments he had picked over the years, he said, you know what? I should have probably had more money in these policies. I should have probably had more here rather than trying to go 100% into all alternative investments. I should have had some cash that's sitting here stable. And so he's kind of like looking back now, kind of the shoulda, woulda, coulda. He's thinking, oh man, I wish I would have had more cash available. And we've got real estate friends that some of them are investors. They'll store like $4 million in cash just sitting here. They won't even use it for investment purposes. They'll literally just let it sit there in cash, earning guaranteed returns. And I know one guy that he actually is the father of one of the people that works with me. He was like a very successful business owner. He actually, the Super Bowl was just recently. He's the one that created the whole coin toss, it was like cointoss.com or whatever it was, like those Super Bowl coins, they made those. So successful entrepreneur. He looks back at all of his entrepreneurial ventures that he's had, even with stock investing and options and everything else. This is the one thing he says, I can always count on this. This is always the money I can count on. And I think that's something that is really important, is that it's the one place you never have to worry. One, you never get a tax form for, which I love because I don't need any more tax forms. And then two, the fact that I never have to worry if I'm going to lose money in it. Like it's never an afterthought. It's always guaranteed,
Well, I guess it's the safety and longevity of most of these top life insurance companies. They've been around for 150 years, and as long as they stick around, right? That's the main thing. It's not a government insured policy, but historically, this has been one of the cornerstones of safe investments in the United States. Not only that, A lot of folks have used them to transfer wealth, right, from one
Right.
generation to another, kind of legacy planning. And then
That's right.
just wanted to add one more comment and then probably wrap up unless there are more questions. The again, being in real estate and alternative investments, a lot of it, real estate investments are illiquid in nature. It's just there's no better way to describe it. It takes time. Real estate moves slow, so you can have a
Yeah.
great investment over a long period of time, but have limited liquidity. There are certain periods of time, especially if you're on the equity of deals, liquidity is limited. Even if you're a lender on a deal, the borrower may not be able to repay on time and you need to extend that, right? There's all kinds of circumstances where investments may still do fine, but liquidity may be limited. And this is one strategy that is highly liquid, which is important for folks to keep in mind. Having more in this creates high liquidity, and there are times when liquidity, cash is the king, right?
That's right. Actually, that's one thing I realized with Alistair McDonald, who you're going to have on here next, right? I mean, Alistair, he was saying in the beginning of 2022, he said, everybody's telling you to not hold cash because you'll lose to inflation. He's like, maybe that's the reason we should be holding cash. And so that's when I started to make that change. I said, you know what, I need to start, getting more liquidity, especially in my life insurance, to do that. And now you're already seeing it, right? Like having availability of funds has been so important. Like you guys have the Mez debt fund. I mean, that's literally like having availability of funds to help like really get this in a better position, right? Than even the people that were the equity investors waiting around. So no, there's so many ways to use it. I remember too, also, Mike, you asked about like using this in a trust, right? One way that General Electric, GE used to do this is they used to put whole life policies on all their employees. So they would get a policy on the employees, they would fund it over the years, and then they would use the cash to pay the pension back when they paid pensions, right? They use the cash to pay the pensions for those employees. But here's the cool thing. What happened when the employee died?
Wow.
Well, that death benefit.
GE kept the death benefits.
Yeah, it replenished the pension fund, didn't it? Right? Because the death benefit went and replenished all the money they'd used to pay for the pension. So it went and filled the coffers back up to then do it again. Walmart was doing the same thing, but then they got so much bad PR because people didn't have insurance for their families, but Walmart had on previous employees that weren't even working there anymore. So Walmart stopped doing it. But that's essentially, if you think about that method, that's what a family trust, that family bank is all about, is set up that trust where the trust is, you not just buy policies for yourself, like you and your spouse are first and foremost, but you can buy on individual kids. It pays into the trust. Then to only get the access to money, they have to borrow. And they're not borrowing from the insurance, they're borrowing from the trust at this point, paying it back with interest to make sure that you create a Rockefeller type of legacy, versus a Vanderbilt who eventually within 3 generations or so, like Anderson Cooper, had no money left, right? And so if you want a Rockefeller type of exponential growth of wealth from generation to generation, this is a great way to do that too.
Yeah,
Yeah.
and I was going to say that
Great.
liquidity is really important, especially because now it's turning into a buyer's market.
It
And
is.
we're starting to see those really good deals come out through foreclosures and, people who have to sell at prices that weren't possible for the last several years. So we're excited about that opportunity. There was one last question that was entered. Typical argument against these policies is that the fees kill the returns. Comments.
Yeah, it's true. That's exactly what I just showed you earlier, Samuel. Like that same thing, where those fees, like especially when they're very front heavy, that's why it kills those returns. And that's the thing you got to look at too. That's why I tell you to use your emergency fund to fund it for those first few years and invest all your money that's already set aside for investing. Like do that. Don't use your investment money up front when you're setting up these policies, because those, and at least in our policies where they are minimized, those fees are minimized to the absolute bare minimum. Even then, like still those first 2 years will be a net cost. But starting from year 3 onward, there's a net gain to them. That's why by year 5, you usually have more in cash in them than what you've paid into it. And that's the key. So yeah, the argument's very much there, because if you get that policy, like I showed you, that 60,000 year policy, she paid in $180,000 over 3 years to have 30,000 bucks, complete ripoff. That's why I couldn't justify it as an investor. But when I realized, oh, well, yeah, 1, I'm protecting my family, which is great. But 2, now I've got this cash that's now stored and protected. And even over time, if you go past like 10 years, even it starts surpassing even what you would earn in CDs and stuff right now. So that's the key thing, is like those first few years, there's net cost because those insurance costs coming out. And I would say that's the downside risk, so to speak. But if you're saying, well, I'm willing to take that downside, I'm willing to slow down in this lane so that I can move over to the fast lane, I'm willing to do that.
Well,
Yeah, I'll add one comment on this thought. So we all pay fees. Sometimes we go for car service and they charge us too much money. And the bottom line is the fees are real for sure. Years ago, I learned exactly that, not to do this because these life insurance policies were fee heavy, and I still did it. My wife's policy for 20-year pay, and gave the broker great income for the first year. His commissions were just and today, even though it's not a perfect setup, I'm still pretty happy. So from my perspective, even with all these fees, there's so many other ways to inefficiently spend your money. yes, it's a little bit expensive upfront, but if you do it the right way, these fees are significantly reduced by working with you, Chris, right? And two,
Exactly.
it's just it's a great saving mechanism. It's a forced saving mechanism. Tax, doesn't live in the tax-free universe. It's the Roth IRA equivalent, and it's access to liquidity. It's
Yeah.
almost to the point where you do it even though there are fees, because there's so many other things that are fees too. And if you invest into anything to minimize the fees, you might miss on a whole upside. It's the same argument as, hey, I don't want to invest into this project because the fees appear to be high, the management fees or the acquisition fees, but it's a great buy. When you look at this, right, if you really understand, it's the value you get, not the fees you pay, right? It's the good
That's
old
right.
relative value versus what are the fees. If you only focus on fees, well, you're going to be counting the pennies and trying to save instead of missing the big opportunity. That's the way to think about it.
Right. That's why I tell people, if you focus just on the first few years, that short-term thinking, yeah, like it's going to look horrible in comparison to just having cash, right? There's no doubt. It's kind of like what Tom Wheelwright, he's the rich dad advisor, for Rich Dad Poor Dad, the accountant there. He even says himself, he says, term insurance is an expense. Whole life insurance is an asset, right? Because that asset does actually have greater value. You'll always get more out of it than whatever you put into it. Especially the way we design it, it's like it's not even, not even a comparison. Like it's way, way more than whatever you get out of it. And arguably, you can even do better than what you do just going in stocks. They've done different studies with different, not by me, but like independent sources saying what's the best mix of your investment portfolio. Do you do, all stocks? Do you do, 50-50, like between stocks and bonds? Do you do whole life with stocks or whatever? Like they just tried all these things, even annuities, right? They're looking at all the different variations. The one thing that over history that they showed with every situation, they would give you more money, now, later, like while you're alive, but also when you're dead, was doing a combination of whole life insurance with other investments, whether it's alternative investments, whatever it might be, which is exactly what that wealth wheel showed you, is that they got to work together. It's not one or the other, right? Because one or the other, they're great independently, but when you get them to work together, that's when you get the best case scenario.
Yeah, agreed. Then you can't replace diversification with anything, right? You have
Yeah.
to always keep that in mind. No single strategy or no single investment, stock market or alternative, does the magic. It has to be a mix of these. And the one thing that you may be 100% correct. I mean, not maybe, 100% correct. There are periods of time when the stock market can outperform whole life policy, and there are periods of time when whole life policy will greatly outperform the stock market. And the big difference is also volatility.
Mm-hmm.
If you can't take volatility and you're sleeping well at night when the market, like it is right now, it's getting a little nervous, right? The PE of the S&P 500 is high, and you're thinking, is this time to sell? What should I do? The whole life policy removes that whole element. If you want predictability and stability, it's a great consideration versus when the market is at the peak or it looks like it's at the peak. Could it have another year or two of a great run, or could it have a significant correction? It all depends on the individual set of circumstances and the comfort with volatility. That's another consideration, right?
Yeah. Yeah. And I noticed I hardly even talk about the death benefit too. Like we were always just talking about the cash value, that tax-free savings account. I had one client where she was 65 years old, and this is like 15 years ago even. And we ended up getting her like a $1 million whole life policy, right? And she was paying like 13,000 a year. She was just paying the bare minimum to be in it. And then after a couple months, she's like, wait, I'm not married. I have no kids. Why do I have this? And so she canceled it. I said, okay, you can cancel. That's fine. I didn't set it up. It was somebody else that set it up for her. I was like, it's fine if you cancel it, but just so you know, we're gonna have to change your financial plan again, because that death benefit gave you a permission slip to spend money while you're alive. Because I was like, because she had 2 million IRAs, I said, you can live on the 3% a year of our IRAs, and should be okay till you're dead. But that's only 60,000 a year. But if you have this whole life policy, even if you lose, quote unquote, lose 13,000 a year, right? Even though it's a lot of it's going to cash, I said, even if you're doing that, here's the thing: is that now you have to only pull out 3% a year if you don't have it. But if you had the death benefit, now you can pull out more cash. I was like, let's run out. Like I basically just did a mortgage calculator. I was like, let's say that you're going to earn only 4% a year in your retirement accounts for the next 25 years. How much can we pull out? So we calculate that. We're like, well, principal and interest, we can now pull out over 100 grand a year. Oh, but guess what? We can also, because you have the death benefit, we can also justify doing a reverse mortgage on your house, where again, nobody's left the bills because it just gets taken by the bank. I'm like, so with that reverse mortgage, now we got another 25,000 plus coming in. Her total cash flow, even when you took out the 13,000 a year, was about 140,000 a year. And I was like, well, just because you have the death benefit, do you want 140,000 a year or just 60,000 a year by not having that death benefit? So she went and got it back again.
The great wisdom. Folks should reach out and chat with you about the individual circumstances and see what makes best sense for their individual circumstance.
Exactly.
Diana, take us home. We're done at this point.
Thanks so much for your time, Chris. I really enjoy it. You know, our conversations are always good, but also learning more about this and how people are benefiting from it. I am really excited to also be able to benefit from this. So thank you. And if anybody has any questions, please don't hesitate to reach out to me. I'll put you in contact with Chris. And there should be some follow-up after this, and we'll post this on YouTube. So you can share it with anyone you would like. Thank you, and have a great weekend, everybody. Take care.
Thank you, Chris. Thank you, Diana. Thank you, everyone.
Thanks.